To see all of our upcoming events, please go to Health at Google. Go to go2/OYL. And also at the end of this talk, if you could take 30 seconds to submit your feedback at go/health@survey, that would be phenomenal. So today we're welcoming Dan Goldie, a #1 New York Times bestselling author, former professional tennis player, and current president of Dan Goldie Financial Services, LLF, a registered investment advisory firm that helps individual investors and families manage their money and make smart financial decisions. He's a trusted advisor to a diverse group of individuals and families. His clients are located in the San Francisco Bay Area and across the United States. His recent book, The Investment Answer, helps individual investors understand how markets work, how to select a financial advisor, and how to make smart financial decisions. Please join me in welcoming Dan Goldie.
Well, thank you. It's a pleasure to be here. I've been looking forward to coming here ever since I was invited, and I hope that what I'm able to do today is really both educate you about investments and educate you about how to be smart savers and smart investors, and but also to inspire you to perhaps change the way that you're investing your money. And if you're already investing your money the way that I'm describing, I hope I inspire you to teach others and tell others and spread the word, because the truth is that so many Americans really need to understand how to manage their money better. And as I go through my presentation, I think you'll understand why, and you'll see how important it is that all of us spread the word and help inspire people to do a better job with their money. Well, let's get started by talking about what's happened to investors in recent times. The economic downturn of 08-09 has had a really dramatic effect on people, in my view, in my practice. It's in the 20 years that I've been in business, I haven't seen such a dramatic impact that an economic downturn has had on people. People have really changed the way they invest and save, and their attitudes about markets have completely changed. For example, there's a large group of people that have just exited markets altogether. They've decided to pull their money out of the stock market and other risky asset markets, and they've basically just deposited the money in cash. There was a recent survey that said that 44% of people who responded said they're never buying a stock again in the rest of their lives. That's how scared people have been. And there's another group of people, besides the ones that have just pulled all their money out, there's another group of people who've decided that markets are basically, the odds are stacked against them, and the only way they can succeed as investors is to get some sort of information advantage. So these people are trying to get hot tips. They're looking for the next hot stock or the next hot mutual fund, or maybe looking for the next investment advisor to get them into the right place to be. They're basically looking for some sort of information advantage that they can use to take advantage of this market dysfunction that people are perceiving as happening today. And then there's the largest group of people that have, I think, always been around, who just say, look, I'm ignoring all of this. I'm just going to ignore markets. I don't understand finance. And who can blame them, because we're not taught about finance in school. And they're just saying, I'm just going to hope for the best, and probably spend more time planning vacations than they do thinking about their money. But luckily, what I'm here to tell you is that markets still work properly. There is still a risk-return trade-off in markets. Markets are not functioning improperly. They're working correctly. And you've probably heard the phrase, a rising tide lifts all boats. Now, this phrase was first made popular by John Kennedy in the 1960s. And as this relates to financial markets, in my view, in the long run, there's this rising tide of market returns. And you can capture this rising tide of returns if you invest in a smart way. Now, the problem is that most individual investors, they don't invest in a smart way. They make a lot of mistakes. And in so doing, it's as though they have holes in their boats. And even though there's this rising tide of market returns over the long run, their returns are far below market levels. And I'm going to show you 5 decisions that we wrote about in our book, The Investment Answer, that you can use to basically ensure yourself that you're going to capture these market returns, or you're going to give yourself the best odds of doing that. And in my view, that's what an individual investor's goal should be. The primary goal should be capturing as much of the return that markets make available over the next 20, 30, 40 years, whatever your time horizon is. That should be your primary goal as an investor. Now, this is so important because of the following facts. So I'll just run these by you real quick. First thing is, we're all living a lot longer than we ever have before. In the United States today, the life expectancy is 77 years for a newborn right now. And what this means for investors, really, in retirement is we're all going to have much longer retirements than we ever have in the past. To give you an example, the average 65-year-old man today has a life expectancy of 85 years, and 25% of those folks will make it to 92. Women live even longer, so the average 65-year-old woman will live to age 88, and 25% of women will live to 94. And for 65-year-old couples, because there's 2 lives, it's even longer still. The average couple has a life expectancy of 92, and 25% will have at least one person reach age 97. Now, if that sounds surprising, consider that the number of centenarians in America, those are the people that are 100 years old or older, the number of those people is going to double by the year 2020. And this is accelerating also. What this means is we have a long period of time that we need to save for. Many people are going to be retired for 30 or more years. And this has not happened before. And the problem is we're not saving enough. Americans, on average, are just not saving enough to have a comfortable retirement. What Fidelity found is that it takes between 12 and 19% of your income, that's how much you have to save every year over a long period of time, so that you have enough money when you retire to live comfortably. The average 401k worker in America today saves only 3.5% of their salary. That's about a fourth of what they should be saving. To put it another way, according to Fidelity, only 15% of workers in the US are on track for a comfortable retirement. That means it's 85% of workers are failing to save enough. And to top that off, a recent survey found that 40% of people responded by saying they don't save anything at all for retirement. So we've got to do a better job. We also know that costs are going up. All of us are aware of inflation. Inflation's always been around, but what a lot of us aren't aware of is the effect that even just a small amount of inflation has on your money. So if you look over a long period of time, let's say 25 years, that's shorter than the typical time horizon for retirement. If inflation runs at 2% average for 25 years, that cuts about a third of your purchasing power. If inflation is 3%, which has been the average inflation rate for the last 85 years, 3% inflation cuts half your purchasing power in 25 years. And 4% inflation takes 2/3 of your purchasing power away. These are pretty significant numbers. And so we've got to save and invest smarter to counteract this inflation effect on our money. Now, healthcare costs are rising even faster than the rate of overall inflation. A recent survey found that the average 65-year-old retiree spends $5,000 a year on uninsured healthcare costs in retirement. And that $5,000 at current rates of healthcare acceleration, the costs are going to double every 10 years. So just imagine how that's going to add up. A recent survey found that it's going to cost a typical man during his retirement period as much as $211,000 to cover these uninsured healthcare costs. And a woman, because women live longer, up to $242,000. That's a lot of money for a couple just for uninsured healthcare. And the last thing is we're not investing very smartly. Most people make a number of different investment mistakes. For example, one thing that a lot of people do is they go in and out of the market at the wrong times. When headlines are bad, or when headlines are good, after the tech bubble, for example, from 2002 to 2007, investors put $700 billion into stock mutual funds in the United States. A lot of that near the highs of the market. And then when the headlines turned negative in 2008, 2009 and markets lost half their value, what investors did is they pulled out $250 billion out of stock funds. So we had $700 billion going in near the highs and $250 billion going out near the lows. And meanwhile, the markets have largely recovered from the 08-09 downturn, but that $250 billion, it hasn't come back into the stock market. And just last week, I read another $5 billion was withdrawn as the market gyrated up and down. So people are moving their money in and out at the wrong times. Another mistake that people are making is they're really getting investment advice from questionable sources. One surprising example that I found was a survey that was done by Cisco Systems, where they found that of investors who are under the age of 50 and have more than $500,000 to invest, that more than half of them were getting investment advice from social networking sites. Sorry, I didn't put Google up there. So we need to get investment advice from reliable sources. And another thing that people are doing, and this is also, I think, very surprising, is we're not diversifying very smartly. As recently as a few years ago, a survey was done that found that in 401k plans that offered company stock as an option, that in these plans, the company stock option was the most popular option in the plan. And 20% of investors had over half their money in their company stock. And we're here in Silicon Valley, so didn't we learn 10 years ago not to put too much money in your company stock because you're loading up on risk of one company? So we need to diversify better. So what does all this mean for investors? Well, for a lot of people, it means that the income that we enjoy while we're working is going to be slashed in retirement. And it's not going to be temporary. For a lot of people, they're not going to be able to recover from this. And we're already seeing this now, but we're talking 20, 30 years of reduced income in retirement. So the future does not look great for a lot of people. What it means, and again, we're seeing some of this now, people are going to have to work longer. In fact, I've seen some quotes from people in the newspaper who are saying that they feel like they're never going to be able to retire. They're so far behind. Another option is they may have to borrow from their children. A lot of my clients tell me this is their worst nightmare, being elderly and having to rely on their kids. And then finally, perhaps a lot of people will just accept a reduced lifestyle. So we need to really change this in America. We need to start saving more. And of course, this begs the question, why don't we save more? Why aren't Americans better savers? Well, I'm sure there are many reasons. One interesting reason that I found that researchers at Stanford and a number of universities are looking into is the fact that our brains are not hardwired to imagine ourselves in old age. And so it's very difficult to convince ourselves that we should be saving for a time period that's so far away in our minds we can't even imagine it. So what they're doing at Stanford and other places is they're taking photographs of students and they're aging the photographs. And so they're showing the students what they would look like when they're 65, 70, 75 years old. And what they're finding is that when these students see their photographs, it changes their attitudes. In fact, one study found that the savings rate of young people doubled when they were walked through this exercise. Now, I thought this was kind of funny, so I thought I'd try it on myself. So this is me today. And through the magic of Photoshop, that's me in, I don't know, 25, 30 years. Someone was nice, they didn't make it too bad. But it does have an effect. And, so we need to start saving more as a society. Now, I know the people in this room, because you're super smart Googlers, that you don't have this problem. You're already saving a lot. And let's say that you already have capital built. So now let's talk about investing, because we also need to invest smarter. So your job as an investor is to capture as much of the market's rate of return as you can. This return is there for the taking, and you should be able to get it. So here is historically what markets have delivered. These are the returns that markets have made available over the last 85 years. Inflation has run about 3% a year since 1926. $1 back in 1926, it now takes $12 to buy what $1 bought back then. Treasury bills have risen at 3.6%, and Treasury bonds at 5.5%. So the realm of fixed income investing which would include things like municipal bonds, money market funds, corporate bonds, government bonds, all kinds of interest-bearing investments. For the most part, those investments are relatively low risk and low returning investments. They don't give you much more than inflation. What gives you more than inflation are equity investments, stock market investments. Large company stocks over this period have grown at 9.9% a year. Small company stocks have grown at 12.2% a year. So equities grow your money to a lot more over time than fixed income. What this chart shows you is two things. First of all, it shows you that risk and return are related. Where there's more risk, there are higher returns to be had over the long run. And secondly, it also shows you what I talked about earlier, this rising tide of market returns. You can see that equity markets and fixed income markets, the capital markets deliver a positive rate of return to you, and it's there for the taking. You don't have to outperform markets. You don't have to be a great stock picker or mutual fund picker to capture these returns. Now, unfortunately, most people aren't able to do that. A recent study by a firm called Dalbar in Boston looked at the last 20 years of returns for mutual fund investors. And what they found was that compared to US large stocks, which made 9% a year over the last 20 years, stock fund investors got less than half of that. And when bonds went up 7% a year, bond fund investors only got 1%. So investors got, over the last 20 years, just barely inflation. They're just treading water with inflation. Why is there this big shortfall? Well, it's basically because investors, for the most part, are actively managing their money. And what I mean by that is they're timing the market, a lot of times without knowing it, but they're moving their money in and out of stock markets and bond markets at the wrong time, buying mutual funds and selling their mutual fund shares at the wrong time. That's a big reason why. And another reason is they're using actively managed mutual funds, which on average underperform markets. Actively managed mutual funds have higher costs than, say, index funds or passive strategies that capture market returns. And because of these higher costs, their average returns are lower. So all this active management, all of this attempt to outperform markets drives up costs, creates mistakes, and causes the average investor to underperform. Now, you may say to yourself, and the cost of this, by the way, has been calculated. Ken French at Dartmouth has calculated that the average cost of active investors is about $101 billion in the United States this year alone. And you may say to yourself now, but I'm not average. None of you in here are average. So a lot of times I hear, well, okay, I understand this is the mathematics of the investment world. If active strategies cost more on balance, and if investors on balance are making mistakes, then of course the average investor is going to underperform. But I'm not average. I don't buy average mutual funds. I buy the best performing funds. I don't pick average stocks. I buy the best stocks. Well, let's see how well that works. Here's a chart showing you the last 10 years. And I've got all the US stock equity funds that have existed over the last 10 years. For the first 5 of the 10, I'm going to show you the Sharpe ratios. These are the risk-adjusted returns of the US equity funds. And I'm ranking them from left to right, highest returning to lowest returning. Now, what you'd expect is that over the next 5 years, this is the 5 years ending in 2010, that the funds that did the best in the past would do the best in the future. But if you look at the returns, it's just a flat line. There's no differentiation statistically between the funds that did well in the past and the ones that didn't do well. So past performance doesn't help in picking funds that will do well in the future. What about Morningstar ratings? Morningstar is a firm out of Chicago that rates mutual funds. They rate them from 5 stars down to 1 star. 5 stars are the best funds, best performers of the past. 1 star are the worst performers. So let's look at the last 5 years, again, for the period just ending in 2010. You'd expect the 5-star funds to do better, right? Uh-oh, it's another flat line. The one-star funds statistically look about the same as the five-star funds and all of the other star funds. Maybe professional managers can do a better job. Maybe pension fund managers, maybe they can select managers in a better way. Well, there was a study that was done that looked at 10 years of results of big pension funds. 3,400 pension funds. And what pension funds do is they will hire money managers to handle an asset class portion of the portfolio. So a pension fund might have 10, 15, 20 managers operating at any given time. And so what the pension fund sponsor will do is periodically they'll fire the underperforming managers. And they'll bring on new ones that have really good track records. So what this study looked at was the 3 years prior to this hire fire date, and there were thousands of these occurrences. And what they found was exactly what you'd expect, that the new managers coming in had significant outperformance over those that were fired. So before they were hired, they looked really good. And the ones that were fired looked really bad. But here's the interesting part. After the hire date, the new ones that came in actually underperformed the ones that were fired. They tracked the performance all the way through. So the pension funds would have been better off if they had done nothing. They actually hurt their returns by switching managers around. The key for me at this point is these pension fund sponsors were not able to identify superior performing managers, just like the mutual funds. So you might be scratching your head and you might be saying, but Dan, isn't the entire financial services industry all about telling us which funds are better, which managers are better, which stocks are better? It's a head scratcher. Now I was confused as well. Now 20 years ago is when I started in this business. This was me. I was a pro tennis player 20 years ago. And in 1991, I retired from the tour because of injuries, and I really wanted to get into the investment field. And so what I did was I started interviewing around with the best and the brightest firms in the San Francisco Bay Area. And what I found when I did that was firms full of incredibly bright, the best and the brightest people, and really impressive folks. But when I would leave the interviews after talking with them, I'd look at their investment results on the marketing materials they would give me. And the investment results were very mediocre. A lot of times they were well below market averages. And I couldn't figure that out because for most of my life up to that point, it had all been about performance. You know, if you were smarter and you worked harder and you were better, then you performed better. But that's why it didn't make sense to me. And then I started talking with some academics and other professionals who were investing in a passive type of strategy. And then it became clear to me that markets really are too efficient. They work too well. Free markets work so well that it really levels the playing field. And it basically, it doesn't allow an investment advisor or an investment manager to consistently outperform markets or consistently beat others. It just levels the playing field. So that was when the light bulb went on in my head and I said, my gosh, this is the way markets work. And that was when I decided that I would start a business around advising individuals about how to invest smarter, capturing market returns, diversifying more broadly, rebalancing portfolios, a lot of the things that Gordon Murray and I wrote about in this book. Now, speaking of Gordon Murray, fast forward 10 years. In 2002 is when I met Gordon. Now, Gordon was, for 25 years, he was a bond trader and manager on Wall Street. And he was a managing director at a number of the big banks, Goldman Sachs, Lehman Brothers, and so on. And he came to me when he retired from that, wanting to have some help with his portfolio. And I explained to him a lot of the ideas I've already talked to you about. And that was when his light bulb went on. And he had heard of these ideas before, but what was so, I think, amazing for him was that he had never seen a way to really put this all together in an organized fashion for an individual investor. And he got so enamored with these ideas that he actually, for the last 8 years of his life, he took a job with a firm that was investing in these passive strategies. And Gordon was an incredible human being. His life was all about making a difference. And he was someone who believed that with commitment and passion that anybody could have a positive impact and make changes on anybody else. And when he was tragically diagnosed with brain cancer, he had terminal brain cancer diagnosis in December of '08. When he got that diagnosis, what he decided to do was basically devote himself to giving back to others. And he did a number of things, including appearing in front of Congress, talking about financial reform, and several other projects. His last project was the book that many of you have in your hands. And he and I worked on that together in the last few months of his life. And I have a video here that I'd like to show you to give you a little feel for what he was like. And it'll tell you the story behind the book and about how we put it all together. So here it is.
Gordon, you were actually diagnosed with brain cancer. I think it must have been pretty close to 2 years ago to the day.
December
right?
08. Yeah.
December 08. Can you tell us kind of what that? I mean, it's sort of I don't want to ask the question in too trite of a way, but what?
No, it's okay.
What went through your mind when you heard that?
You know, it was pretty much of a blur, but I know that literally 2 days later I was on an operating table. You're pretty much dead on diagnosis. So, and it's made clear to you. I mean, in as caring a way as possible. But so it was not that hard for me. You accept that your days are numbered, and if you embrace the disease, and I'm not knocking people that are very private, but the fact is, if you do that, then you might have a platform for helping other people. You fast forward to, and we knew this day was going to come, but I guess it had been about 18 months. It was June 8th, and I had a scan which showed another tumor, which is a very bad sign, inoperable, not treatable. The second tumor was, the decision was made, no chemo, no radiation, no Avastin, none of the treatments that'll put you in the fetal position, which may have actually accelerated things, or it may have bought me another few months. But if we did nothing, then it would be a good quality 6 months. When Dan and I wrote the book, we felt, as you recall, very strong that we wanted the book to stand on its own. And, you know, after the review of about 36 academics and industry professionals, it became very clear this worked, that we captured something here. And so it was then, and Dan was wonderful about this, respecting my privacy, and everybody talks about their demise or their physical situation differently. But he said, well, you know, this is a great story. And so it was then that we felt comfortable talking about the story of the book, which was one really of friendship, love, collaboration. I think you can elaborate a little more.
Well, this was when you were about to give a speech, basically, the next day that you heard that you might have like 6 months left. Dan, I think you were one of the first people he called, right? I mean,
yeah, I remember very well getting the call. I was in Monterey for a conference. I was about to speak that evening, and Gordon was going to come down the next day to speak. And he called me, and he said, you know, that he had this scan and that they had given him 6 months. And for some reason, I was sitting in my hotel room, I'm holding the phone to my ear, and I had known that he'd wanted to write this book for a long time, and we talked about it a few times, and we just never did it. I didn't have the time really, and he was doing other things, and for some reason, when he said those words to me, I just said immediately back, we have to do that book that you've been wanting to write. And he said he didn't have it in him, didn't have the energy.
Are you crazy?
yeah.
And so I started sending him titles, ideas for titles, reworking some of the things that he had done earlier. He had the bones of the book already done a few years earlier. So I found in my hard drive his work, and I started giving him revisions and reworked chapter 1, chapter 2, and I got him hooked.
All right, you got me, and he just got hysterical.
So that's Gordon. He was an incredible human being, and by the way, he rejected all of my title ideas. So the title was his idea. The light bulb on the cover was mine. He was an incredible human being. He was one who just, as I said, believed in giving back to others, and imagine in the last months of life being just totally devoted to sending this message that he thought was so important for investors to hear. So it's really been great for me to carry on his legacy. Now the book that you have, here it is, the book that many of you have. The book didn't start out this way. It started out as a self-published paperback, because when we started writing the book, Gordon's health, we didn't have the time to go to a publisher. He had only had a few months left. So we wrote the book very quickly. I spent many all-nighters doing that, and so did he. And it was incredible, his energy level and his commitment to making this project a success. Our big break came when Ron Lieber of the New York Times took an interest in Gordon and the story and the book, and he wrote a featured piece, and this is Thanksgiving of last year, that basically went viral online. And when that piece went viral, the website for the book got like 100,000 visitors, and we had printed up 30,000 copies of the book, which were sold in about 3 days. And we got national media attention, and then we got publishers contacting us and literary agents contacting us, and we were able to get the book turned around in a matter of about 5 weeks, which is an incredible time period for a book to be turned. And then this book came out in the 3rd week of January of this year. And because of all the national media attention that we had received from Thanksgiving until January, the book debuted as the #1 New York Times best-selling business book and stayed there for 2 months. So it was just an incredible thing that Gordon's legacy became so popular and has already touched so many people. Now, unfortunately, Gordon passed away on January 15th this year, so he didn't see the New York Times list, but he was able to hold the book in his hand before he passed. So it was a bittersweet time for all of us. But anyway, so now let's talk about the concepts of the book. So in the book, what Gordon and I talk about are 5 key decisions. This is the core concepts of the book. The first decision is the do-it-yourself decision. Now, here in this room, because you're super smart Googlers, you probably buck the trend of this. But Gordon and I really feel that most people should really think seriously about getting investment help. And here's the challenge that most investors face. Most of us have an emotional cycle that makes it very difficult for us to invest in a disciplined way. And here's what I mean. When markets go up, we become optimistic, we become elated, we become confident. And what happens when we get all these positive emotions? That's when we want to buy. So when the expected return is the lowest after markets have run up significantly, that's when we most want to buy. And when you look at mutual fund cash flows, for example, that's what you see. Money going in at or near market highs. And then when markets turn south, we get nervous. If they go further south, we get frightened. We may panic, and we want to, of course, sell. So we end up, what our emotions have us wanting to do is to buy high and sell low. And of course, the cycle goes on. If you buy high and sell low often enough, you're going to really hurt yourself. Now, fortunately, the investment media is there to encourage us to do this. I especially love Jim Cramer's photograph, with the mad money. So the investment media amplify this, and in my view, make it worse for investors. All of this noise, which is what I consider this noise, it causes us to want to do even more of make these mistakes. How many times have you watched a show like this? I know I have, where the host turns to the guest and says, "What should our audience do tomorrow morning when the markets open?" And of course, there's an answer. Well, the truth is, you should do nothing. If you have a proper long-term investment plan, you shouldn't do anything tomorrow morning when you wake up and the market's open. A good advisor wipes away all of this noise and helps keep you focused and disciplined, just like a good coach. Like when I was playing tennis, I had a coach. Every tennis player that I knew had a coach. A good coach is someone who has advantages that brings things to the table that you can't bring. Experience, discipline when it comes to money. An advisor is not emotionally tied to your money like you are. So there's a number of things, a number of ways that a good advisor acts like a good coach. Another way to think of this is to think, well, if you had a serious health condition, would you ever deal with that without consulting with a doctor first? Well, Gordon and I always talked about good advisors being like good doctors, where you get good quality, fair, impartial advice. So a couple of tips about advisors. If you're thinking about looking for an advisor, tip number one, you only need one advisor. Diversifying advisors is not diversification. The reason you only need one is because if you're investing the way that Gordon and I are describing, where you're basically capturing market returns, investing in a long-term plan with diversification and rebalancing, using index funds or ETFs or other passive strategies, you really want one person to set that strategy for you. If you get more than one person involved, you run the risk of things getting convoluted. Second tip, hire an independent fee-only advisor. You don't want your advisor to receive payment, let's say higher payment for giving you one investment product over another, or having their investment products that they can offer you limited by their firm, or having their investment philosophy dictated to them by the firm they're working for or the boss they're working for. You want someone who's paid only by you and who has the freedom to give you truly independent advice, to do what they think is in your best interests. Okay, the second decision, asset allocation decision. So here we're talking about how you divide up your money across the major asset classes of stocks, bonds, and cash. Now, most people come to this the wrong way. They come to this, they back into this. Most investors will accumulate assets, accumulate investments over their investment lifetime. They'll buy things as they go along, and they'll sell some things as they go along, and then at some point, of course, they'll have some sort of allocation, but they won't have thought about it ahead of time. A better way to do this is to figure out the right allocation for you, given your risk profile and your goals, and then fit the investments into that allocation plan. Now, you already know that cash and bonds, fixed assets are the low-risk, low-returning assets. You also know that stocks are the high-risk, high-returning assets. So let me point out the obvious. There are no low-risk, high-returning assets. As much as we'd love to see that, markets don't allow that to be. Everybody would, if that were true, then of course everyone would flock to those investments, and it would level itself off. So as an investor, what you want to do is allocate your money based on your risk profile. So a conservative investor will allocate more money to fixed assets, less money to stocks, and a more aggressive investor will allocate more money to stocks. And you can do this on your own. In fact, in the book, towards the back of the book, we provide sample portfolios. For those of you who are interested, you can look and you can see some portfolios for different levels of risk, and you can try and figure out where you fit on there. And you can take that allocation and you can use that in your 401k plan or on your own. Okay, so now the third decision, diversification. I learned about this at a very young age, actually when I was playing tennis. When I was a young tennis player, coming up in the juniors, I used to play a rather aggressive game. So I would hit the ball hard, and I liked to go for the lines. We used to call this painting the lines when I was a kid, where you hit the winner in spectacular fashion off the court, away from the opponent, right, skidding it off the line or right near the line. So it's a low margin for error way to play. Now, I got away with that when I was a young player because I just was better than most of the people I was playing against. But as I got older, I couldn't play that way, and I learned that I had to play a higher margin game. I had to not go for the lines because it's too easy to miss by an inch. And that's exactly what diversification does for you. Diversification evens out your results. Diversification cuts the highs and the lows out and gives you more consistent returns. Here's an example. Let's say you have two assets. One asset fluctuates up and down, call it asset A, and another asset also fluctuates up and down, call it asset B, but you'll notice that they don't correlate perfectly. In fact, in this example, these assets are negatively correlated. The correlation is -1. So if these assets existed, and unfortunately they don't, but if they did, you could invest in both of them, half your money, and you'd have a perfect investment. Your portfolio would never go down in value. It would always go up, no risk. So obviously this doesn't exist, but it gives you the idea, it helps you understand the concept that if you diversify across asset classes that don't move together perfectly, there is a diversification benefit, a risk reduction benefit. Here's a real world example. This is the S&P 500, large US stocks. These are the decade by decade returns for the last 8 decades. Now the average return above inflation, 6% a year. What you'll notice is that 4 of these decades, these are 10-year periods of time, by the way, this is a long time. 4 of these decades were quite poor. Now what most people do when they invest in stocks is they only buy US large company stocks. Now if you invested in US large company stocks for the last 10 years, look how badly you did. This is what some people are calling the lost decade, because the returns were so bad for the US market. Now 3 of the decades were great. The 80s and 90s in particular, that was a phenomenal 20 years. If you were invested in the S&P 500, you had incredible results for the 80s and 90s. Only 1 decade was really close to the average. So what's the lesson here? To me, the lesson is that you need to diversify across multiple asset classes, not just one. You need more than just large company stocks. You need asset classes like these. We've got international stocks, bonds, small company stocks, value stocks, emerging market stocks, real estate investment trusts, lots of different kinds of things that don't all move together. If you look at all these asset classes over the last 15 years and rank them each year from highest to lowest, you see what looks like a chart of chaos. There's no apparent patterns, there's no apparent rhyme or reason why some asset classes outperform others in certain years. And there's, if you take any color, you can't see any trending or any reason to the chart. But there is a very logical, solid, underlying risk and return situation that goes on there. You just can't see it until you start building diversified portfolios. Here are 6 sample portfolios going from 0% in stocks all the way up to 100% in stocks. Those are my creative names for the portfolio, 0, 20, 40. And these are some simple asset classes: real estate, large stocks, bonds, emerging markets. So if you did something like this with your money, and you invested in index funds or some sort of passive strategy to capture the market returns for each category, and you rebalanced your portfolio regularly, if you did that, for the same 15-year period, now you see the portfolios now are ranked from high to low. And you see now that risk and return line up perfectly. In the years when the market goes up, the 100% stock portfolio does the best. And in the years when stock market goes down, 100% stocks does the worst. It's exactly what you would expect, and it lines up perfectly by risk every single year. So now you're investing smartly, you're diversifying properly, you're capturing risk and return, and you can see how it's related in markets. The 4th decision, the active-passive decision. Are you going to invest actively, or are you going to invest passively? So we've already talked about this quite a bit. Active investors are trying to beat the market. These are folks who are trying to look for mispriced securities in one way or another. And to me, active investors are kind of like gamblers at a casino. So let's say a bunch of gamblers go to a casino one night. They know the odds are stacked against them. But still, even so, during that evening, some group, some segment of those gamblers they're gonna end up making money that night. The majority will lose money, but some will make money. And this is what you see with active investment managers as well. But if those same gamblers went to that casino night after night after night, the longer the time period, the worse they would do. And eventually they'd end up all losing money because the odds eventually would catch up with them. And it works the same way with investments. A smarter strategy is to invest passively. And you can do this easily. In your 401k plan, you can invest in index funds, On your own, you can invest in exchange-traded funds or other strategies that are designed to capture broad market returns. A passive investor believes that markets grow over time, that rising tide of market returns, and that capitalism builds wealth. And if you're a long-term investor and you invest that way, Gordon and I believe you'll have much better investment results. The final decision is the rebalancing decision. And to a lot of people, this sounds like the easiest one. What this means is once you have an allocation strategy in place, what will happen is over time, markets will move your mix around. As markets move up and down relative to each other, your asset allocation will change. And you need to periodically then rebalance back to your targets. It sounds easy enough. But consider that your emotional response is the opposite of the rebalancing discipline. Remember that our emotions want us to buy high and sell low, and rebalancing tells you to buy the underperforming asset, because the asset that's done the worst recently is the one you're going to be underweight, and the one that's done the best recently is the one you're going to be overweight. So rebalancing has you selling assets that have outperformed and buying the ones that have underperformed. It's the opposite of what your mind tells you. It's very difficult to do because of that. For example, in 08-09, when markets lost half their value, when the stock market went down by more than 50%, rebalancing, that discipline would be saying to you, when the market's going down, periodically you should be buying stocks. You should be selling your bonds and buying stocks. And that was very hard to do during that period because everyone was saying, well, the market, the world is coming to an end here. Markets are going to keep going down. It's very hard to buy into stocks during a time like that. So these are the 5 decisions. Now, Gordon and I believe that anybody can follow these, who follows these 5 decisions will have a very successful investment experience. Now, the one thing that can trip people up is losing focus. Now, I learned, well, one question that I've often been asked is, what is the single most important lesson you learned from your sports background that you can apply to investing? And my answer is having tunnel vision, having that ability to focus and not lose track of the long-term goal. So let me give you an example of that. I used to play, when I was playing tennis, I played at the US Open 7 or 8 times in the 80s and early 90s. And this tournament is a wonderful place to play. It's the biggest tournament in the world. For Americans, it's probably the most important tournament that we play in. It's also the most distracting place to play tennis. I mean, just look at that. You've got 15 or 20,000 people yelling and screaming. You've got planes flying overhead. You have, you can't see this, but you have the smell of hot dogs and hamburgers coming around the grounds, particularly the outside courts where they have all the food service and so forth, right nearby the court. It's a very distracting place to play. Now, one time when I was playing on center court, when I was a young player, I was warming up for my match, and I was about to start warming up my serve. Now, normally when you hit a serve, when you're a tennis player, you throw the ball up and you're about to hit the serve, you just normally see some sky, clouds, maybe the sun is about the worst thing that would distract you. But on this particular occasion, I'd never seen this before, but I threw the ball up for the first time and I saw a giant blimp. It was circling the stadium, and it made it really hard to see that ball because I was throwing it up there and there was a blimp in my line of sight. There are a lot of blimps in the financial world too. There's a lot of things out there to distract you. Your own emotions, the financial media, the security salespeople. There's a lot of blimps out there. You got to stay focused. Now, getting back to this rising tide lifts all boats, this is what I want you to stay focused on. The long-term returns that markets deliver, and your job, as I said, is to capture your fair share. Capture as much of that return as you can. Now, unfortunately, the bad news is most people don't do a good job of this. Most people don't, for example, they don't hire the right advisors. Gordon and I believe, as I've said, people should hire independent fee-only advisors, but we only have about 12% of the money. All the rest of the money that's managed for individuals is managed by the brokers, the banks, the insurance companies, all of the folks that may have various conflicts of interest and other issues. Another mistake people are making, only 11% of money is invested passively. And most of that money is not invested in diversified portfolios, it's invested in large company stocks. Another mistake is, unfortunately, people just don't know very much about finance. In fact, one study showed that more than half of adults over the age of 50 couldn't answer 2 simple questions about compound interest and inflation. It's because we aren't taught in school about these things. The good news is, you guys now know. You know about the 5 decisions. You know about how to make smart decisions about hiring an advisor if you so choose, how to diversify, how to allocate your assets smartly, how to rebalance your account, the benefits of passive investing. You now have the tools at your disposal. Now you don't have to worry about money. You can spend your time at work, focusing on your job, focusing on your family, doing other things. And if you're already investing this way, great, keep it up, and please share this information with others. Because even if you've been investing this way, or even if this is new to you, I guarantee you that a lot of your friends, your family, your neighbors, this is all going to be very new information. And if we can all get this word out to save more and invest smarter, then it's going to make a big difference for a lot of people in the long run. So thank you for coming. And I will take questions.